Most business owners are paying more in taxes than they need to. And the reason usually is not that they don't know write offs exist. The reason is that nobody explained which ones apply to them, how to actually take them, and what documentation makes them hold up if anyone ever asks. And with the major tax law changes that happened in 2025, there are some things worth revisiting, even if you've had the same account for years. The One Big Beautiful Bill Act that passed in July changed a lot of the rules around depreciation and equipment deductions. And most business owners do not know about it yet. I am Aldo Leal. I am a CPA with a background in corporate finance, where every number has to be defensible. So when I work with business owners and look at what they are deducting, I consistently find the same gaps. Legitimate write-offs they qualify for that they're either not taking at all or they're taking incorrectly because someone gave them half the information. Today, I want to walk you through 7 of the most commonly missed write-offs for small business owners. For each one, I'll explain why it gets overlooked, who actually qualifies, and how to take it correctly so it holds up if the IRS or a lender ever looks at your book. Let's start with one that has a reputation problem: the home office deduction. A lot of business owners avoid this one because they have heard it triggers audits. That was true 20 years ago. It is not true anymore. The IRS knows that millions of people work from home. Taking a home office deduction doesn't put a target on your back. Taking it incorrectly does. Here's who qualifies. You need a dedicated space in your home that you use regularly and exclusively for business. That word exclusively is the key. A desk in your living room where you also watch television doesn't count. A spare bedroom you converted into an office does. A section of your basement that's only used for work does. There are 2 ways to calculate it. The simplified method gives you $5 per square foot up to 300 square feet, which means a maximum deduction of $1,500. The regular method requires more work, but usually gives you a larger deduction. You calculate the percentage of your home used for business and apply that percentage to actual expenses like mortgage, rent, utilities, insurance, and repairs. Now, let me give you some practical tips to make this deduction bulletproof. First, take photos of your office space. Remove any personal items first: kids' toys, exercise equipment, anything that suggests that the room is used for non-business purposes. You want the photos to clearly show a dedicated workspace. Date the photos or email them to yourself so you have a timestamp. Second, measure the room and write it down. Keep a simple diagram showing the dimension and calculate the square footage. If you're using the regular method, you'll also need the total square footage of your home so you can calculate the business use percentage. Third, keep your utility bills, mortgage statements, or rent receipts at home insurance documents organized. You don't submit these with your return, but you need to have them if anyone asks. One important note: this deduction is for self-employed individuals and business owners. If you are a W-2 employee working from home, you cannot claim this on your federal return, even if your employer doesn't reimburse you. That rule has been in place since 2018 and was made permanent under the new tax law. The second write-off I see missed constantly is retirement contributions. When you work for a company, they usually set up a 401k for you and sometimes even match your contributions. When you're self-employed, nobody sets that up for you. And a lot of business owners just forget they can still do it, or they assume it's complicated and put it off. If you are self-employed, you have access to retirement accounts that can shelter a significant amount of income from taxes. Let me break down your 2 main options for 2025. A SEP IRA lets you contribute up to 25% of your net self-employment income with a maximum of $70,000 for 2025. This is simple to set up and maintain. You can even open one and fund it all the way up until your tax filing deadline, including extensions. A solo 401k gives you more flexibility. You can contribute up to $23,500 as an employee deferral, plus up to 25% of your compensation as an employer contribution. The total cap is also $70,000, but the structure means you can often contribute more at lower income levels compared to a SEP. If you're 50 or older, you can add another $7,500 in catch-up contribution. And there's a new provision for 2025. If you're between 60 and 63, your catch-up limit jumps to 11 to 50. These get missed because they require you to set up the account and make the contribution yourself. Nobody's doing it automatically through payroll. So it falls off the radar, especially in business years when you are focused on running the business. For practical tips, set a calendar reminder in October or November to review your projected income and decide how much to contribute before year end. For solo 401ks specifically, the plan must be established by December 31st. You can fund it later, but the account has to exist. SEP IRAs are more flexible and can be opened and funded all the way until your tax filing deadline. Once the accounts are set up, keep your contribution records and year-end statements. These show how much you contributed and when, which matters for the deduction. Self-employed health insurance. If you are self-employed and pay for your own health insurance, that premium is deductible. A lot of business owners don't realize this, or they assume it's already included somewhere on the return when it isn't. This is different from a regular business expense. It's an above-the-line deduction, which means it reduces your adjusted gross income before you even get to your standard or itemized deductions. That makes it more valuable than a typical write-off because it can also affect income-based phase-outs. Starting in 2024, there's a dedicated form for this. It's called Form 7206. It's specifically used to calculate the self-employed health insurance deduction. If your accountant is not using it, ask why. The confusion happens because it's reported in a different place on the return than other business expenses. If your accountant doesn't know you're paying for your own health insurance because they never asked, it might not be on there at all. You need to be self-employed with net profit, and you cannot be eligible for employer-sponsored health coverage through another job or a spouse's job. The deduction is limited to your net self-employment income. You cannot use it to create a loss. You can include premiums for your spouse, dependents, and even children under 27, whether they're your dependents or not. For documentation, keep every premium statement or invoice. Create a simple log showing which months you paid premiums and confirming you were not eligible for employer-sponsored coverage during those months. Professional development. Number 4 is one most people don't think of as a write-off at all. Professional development. Courses, coaching programs, conferences, books, certifications. Anything that helps you get better at running your current business is a legitimate business expense. But most business owners don't track these. I have seen business owners spend thousands each year on courses and masterminds and never deduct any of it because they paid with a personal card or didn't think education counted. The rule is straightforward. If the education maintains or improves skills required in your current business, it's deductible. A web designer taking a course on new design software, deductible. A consultant joining a sales mastermind, deductible. What is not deductible is education that qualifies you for a completely new profession. A plumber taking classes to become an accountant, that is not a business expense for the plumbing business. When you buy a course or register for a conference, write a one-sentence note explaining the business purpose. Save it with a receipt. If you travel for a conference, keep the agenda or event schedule. This shows it was business related, not a vacation with a conference name attached to it. Cell phone and internet. If you use your phone and internet for work, a portion of those expenses is deductible. People miss this because they assume that personal use disqualifies the expense entirely. It doesn't. The IRS allows you to deduct the business use percentage if 60% of your phone usage is work-related, calls with clients, emails, business apps, you can deduct 60% of your bill. Same with the internet. The mistake is either ignoring this entirely or claiming 100% when personal use clearly exists. Be reasonable. 50 to 70% for mixed use is defensible. 100% raises questions. To document it properly, pick one typical month and review your usage. Look at call logs, screen time by app, and data usage. Calculate the business percentage and write it down with the date. You only need to do this once a year unless usage changes materially. For a cleaner deduction, consider a separate business phone line. Then it's 100% business. No allocation needed. This also applies to devices. If you buy a laptop or phone used primarily for business, it is deductible either fully or proportionally. And with the 2025 tax law restoring 100% bonus depreciation permanently, you can write off the full cost of qualifying business equipment in the year of purchase. Number 6 is the death by a thousand cuts problem. Software and subscriptions. Individually, each subscription feels too small to track. $20 here, $50 there. But most business owners are spending thousands per year on software they never deduct. Accounting software, email marketing, project management tools, cloud storage, scheduling apps, design tools, website hosting, all deductible. These get missed because they are often charged monthly to personal cards in small amounts that don't stand out. Nobody adds them up at year end. Here's what I recommend. Set aside 1 hour, go through every bank and credit card statement from the last 12 months. Look for recurring charges. Create a spreadsheet with 3 columns: the service name, monthly cost, and business purpose. Going forward, use a dedicated card for software and make tracking painless. Don't forget annual subscriptions, domain renewals, professional memberships, annual licenses. Those are easy to miss because they only hit once a year. Number 7 is one everyone knows about, but many people still get wrong: vehicle expenses. You have 2 basic methods: the standard mileage rate or the actual expense method. The 2025 standard mileage rate is 70 cents per mile, and the IRS has announced that the 2026 rate will increase to 72.5 cents. With the standard mileage method, you track business miles and multiply by the rate. Simple and low maintenance. This works especially well for fuel-efficient vehicles, where your actual cost per mile is far lower than the IRS rate. The actual expense method tracks gas, insurance, repairs, depreciation, and deducts the business use percentage. It can yield larger deductions, but requires stronger documentation. Here's where the big opportunity is missed. If you bought a vehicle over 6,000 pounds GVWR, depreciation rules change. Large SUVs and trucks are not subject to normally luxury auto limits. Under Section 179, the SUV cap is 31,300, but bonus depreciation applies to the excess. Using bonus depreciation above the cap can unlock the full deduction. Key documentation includes a mileage log and photos of the GVWR sticker inside the driver's door jamb. It shows 6,000 pounds or more? Take a photo. That's what supports the enhanced deduction. Always log miles contemporaneously. Don't reconstruct logs from memory. Apps like MileIQ or Everlance make this easy. So those are 7 write-offs most small business owners either are not taking or aren't taking correctly. Let me add one more that isn't exactly a write-off, but is often misunderstood: the qualified business income deduction. If you're a sole proprietor, a partner, or S-Corp shareholder, you may be able to deduct up to 20% of qualified business income. This is on top of regular expenses. The new tax law made this deduction permanent, and the phase-out thresholds increased to $75K for single filers and $150K for married filing jointly. Even above those levels, there are ways to qualify depending on wages and industry. This isn't something you calculate yourself. Your accountant should handle it. But if they've never mentioned it, ask. The standard for any write-off is simple. Could you explain what you deducted and why you qualified for it if someone asks? The IRS, a lender, or buyer. If yes, take it. If not, fix it before you claim it. If you want someone to look at what you might be missing, I do free 15-minute calls. Links are in the description, or you can scan the QR code. I'll see you in the next one.